So the 1090 split is something that I talk about in almost every video. A 1090 split has to do with a whole life insurance policy where we are simply minimizing the base premium, which does not show up in cash value in the first year. We're going as low as we can, which is typically right around 10%, especially with the major mutual companies. And then 90% of our payment is allocated toward PUAs, which accelerate the immediate cash value and also the long-term cash value. But when it comes to this design, what is the truth about it? Really, when I look at history, actual data points, is corporations, banks, wealthy individuals that take out cash value life insurance policies and they're interested in the cash value are going with policy designs like this. Either a 1090 split, maybe a little bit lower. Some companies of the major mutuals, you can go a little bit lower. It depends on the company and their rules. I talk about all the time. But also what's truthful about it is when we look at the compensation to an advisor, to an agent, it is also minimized. So naturally, there's a lot of pushback around the idea of a 1090 split from agents stating, you don't want to go with a 1090 split because it might have some additional risk to it for some reason that we can't even explain. Now, that's not meant to take a shot at anyone or anything like that, but coming up in the industry and working for people that were very focused on growing a business and looked at premium production, they said, hey, the base premium is what sells, it's what makes you money, what makes the company money, that's what we want to sell. Anytime when I was growing up in the industry, anytime I would question my superiors at a company, an organization, whatever it might be, and say, hey, corporations that put a ton of money into these products are going with these type of designs. But then individuals, why are we showing them something different? Well, you just want to do that because. I would get an answer, oh, well, if you go with a minimum premium, it can mech. Like, okay, but why? We just don't do it because. Could never get answers. Not until I really started doing what I like to do and where I learned all of this stuff, designing policies for corporations and seeing the truth. And really, if I'm going to try and simplify it here, why individuals, when I say individuals, agents, advisors in the business are comfortable with 1090 splits for corporations is if a corporation's paying $1 million per year into a policy, that's still a $100,000 base premium, which is a very sizable base premium, which results in a very sizable commission. So a larger pool of money, a larger contribution results in a larger commission at the end of the day. If I look at a pure bank-owned or pure corporate-owned life insurance policy, the commission rate might range between 2 to 4%, but it could be on a $10 million deposit. So that's typically what I've seen is minimum premiums. A lot of agents and advisors are comfortable with them because they're larger dollar amounts. But when it comes to a couple of bullet points, really what I want to touch on here is what a 1090 split gives you. Just to state some facts, strongest guaranteed values you can possibly attain in a whole life insurance policy. Meaning when you look at an illustration and you're looking at the guaranteed values, if that is important to you, you want to take what is guaranteed, get the greatest overall value in your policy for your money, cash value and death benefit. A 1090 split or a minimum premium policy will accomplish that for you. Proof of performance. This is the biggest thing in my opinion. Minimum premium designs, meaning a 1090 split, 10% premium, everything else toward PUAs have consistently delivered the strongest actual cash values, not illustrations. This is based on actual data from the corporations we've worked with. We just conducted an intensive historical case study with policies dating back to 1975 all the way to current, meaning the present where we're at right now, different issue dates. And what we've seen to be so consistent is policies with minimum premiums, particularly with the big four major mutual companies, we have that proof. The data's there. Like regardless of what the illustration projected, we see the strongest actual results there. And I want to touch on a point here. Have you ever heard with a whole life insurance policy that if you go with a higher base premium, you should have greater long-term performance? And it can even be proven out on an illustration. And guess what? it can be proven out on an illustration. Meaning I can take a policy with the same product, the same company, same out-of-pocket for the consumer, and manipulate that illustration to have less money up front because I'm jacking up the base premium, going with a higher commission, and project greater long-term value. And that has to do with how dividends are paid on base premium compared to PUAs. But the big thing is that's not shown in illustrations, but almost always happens, and anyone who's been in the business for a long time knows this, is when it comes to how dividends are paid on base premium dollars, they project one thing on illustrations, but they almost always underdeliver. Like everyone knows that, just no one wants to talk about it because it makes the product less attractive and people might not buy. Meaning if I'm going to show you a product that illustrates you're going to have $1 million in 10 years, but then I tell you, it'll probably actually deliver maybe $750,000. You look at it and you say, wait a minute, it says $1 million here. But I say, yeah, the truth of it though is they tend to under-deliver, just so you're aware. Like I'm just being straight up with you. Rather than say, yeah, you're going to have the million and then it under-delivers. Like, no, we know what is actually going to happen. History has shown us that time and time again. And when policies under-deliver, that typically happens with higher base premiums. When I've got a smaller base premium and a higher PUA allocation, it can still happen, and it does still happen as dividends come down, but that impact is minimized. And to simplify, looking at the big players, corporations, banks, wealthy individuals, guess what they do? 1090 splits, minimum premium products, their cash value is there right off the bat because proof of concept, aside from what those projections show, it's so valuable. Here's a big one, minimizes agent compensation. I touched on this in the beginning. No matter how you slice it, that base premium is the #1 driver of agent compensation. So if you are going to go with a 1090 split and a minimum premium policy, what's going to happen to the agent's commission? On base premium dollars upfront and via renewals, they're pushed down as low as possible. But the consumer, the policyholder's cash value is pushed up, short-term and long-term. So if you're the consumer and you can have more guaranteed cash value on paper upfront, proof of performance, most non-guaranteed illustrations project more long-term, and you likely will have more long-term based off of proof of performance, but the agent compensation is minimized. Why would I go with something that has less upfront for the hope or potential that I might have more long-term? Like when it's never happened. Like we see this stuff, hear it all the time, but at the end of the day, like you gotta have the proof. The proof is more guaranteed, more greater actual data, so more stronger actual performance based on actual data, not illustrations of what I can prove through some fake illustration, not a fake one, you know what I mean, but it minimizes agent compensation. Like that's it at the end of the day, just factual points. And then the last one, which I just have to mention, we've done so many MEC studies, like it doesn't MEC. We've heard that 1090 splits have MEC'd in the past. I've heard 40/60s have MEC'd in the past. I've even heard 90/10s with a 90% base, 10% PUA has MEC'd in the past. If you design it properly and MEC test a policy based on guaranteed assumptions, midpoint assumptions, the current dividend, everything, it's quite simple to forecast if a MEC will occur or not. Typically, when we have seen or heard 1090 splits producing a MEC, is something where a level term rider is used and someone cut it after year 7. Like, yeah, it's going to MEC if you keep pumping money into it because you've got the MEC test beyond the first 7 years. Or there's some additional information that is not disclosed in some scary story about a 1090 split MECing, something like that. My point is, this is your money going into a policy. If you're considering a whole life insurance policy, you want maximum cash value from start to finish. That's why you're purchasing it. This also gives you the maximum death benefit long-term as well. If it is something you are interested in, I'd consider it. Compare it to other splits, other designs. You can compare the different MEC tests and such. But what we want to avoid is what a good friend, he purchased a policy through us, and I've learned a lot from him over the years, what he refers to as FUD. Fear, uncertainty, and doubt. When we hear that planted into our minds to try and scare us away from one option without getting all of the information, that's where people make mistakes. because we go with someone that we trusted for whatever reason. They scared us away from someone else, and then only to find out after the fact, oh, I should have listened. But instead of just costing me my feelings, it's costing me $100,000. Anyway, I hope that this has been helpful. If you'd like some actual data, we've got, I don't know, 100 videos on this as far as really digging deep with the MEC limit, agent compensation, everything, major mutual companies. I do hope that this has provided some value. If it does, please hit the like button, subscribe for more, reach out with any questions, and as always, I do hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.